First, I would start by saying this is not a new topic to you. In your financial reporting of the intermediate level, or if you did the old syllabus in your financial reporting of section 3, you did a topic called accounting for pension. We are going to use almost the same terms. It's only that we are going to develop the topic further than you did it at the intermediate level. Now, so that's what I'm saying. This is not a new topic to you. Now, you remember what is a pension scheme, or what we can call a retirement scheme. Of course, a retirement scheme is an arrangement whereby the employer normally promises to provide benefits to the employees when they retire. A retirement scheme or a pension scheme is what we normally say it's an arrangement whereby the employer promises to provide benefits to the employees when they retire. So you now know what's a pension scheme or what's a retirement scheme. Now, the question is, how does a pension scheme operate? How does a pension scheme operate? Now, normally in a pension scheme, normally contributions are made to a pension fund. Contributions are normally made to a pension fund. Those contributions are made either by the employer and the employee, or some in cases it may be the employee, but in most cases it is both the employer and the employee. They make a regular contribution to a pension fund. Those contributions, you know, they are normally invested by whoever is the funding agent. Then it is this funding agent who normally pays the benefits to the employees when they retire. So in essence, that's how a pension scheme operates. That's how a pension scheme operates. That in a pension scheme, regular contributions are made by the employee and possibly by the employer and possibly the employee. They make regular contributions into a fund. This funding agent may be an insurance company. There are some insurance companies that normally manage pension schemes on behalf of companies. Or this funding agent may be a trustee like NSSF. So NSSF is a funding agent. We normally refer to it as a trustee. Okay? So we are saying contributions are made to a funding agent. Those contributions are normally invested by the funding agent, and then it is the funding agent who pays the benefits to the employees when they retire, whatever time they will retire. So now you know how a pension scheme operates. That contributions are made to a funding agent. Those contributions are invested by whoever is the funding agent, whom I'm saying it could be an insurance company or it could be a trustee. There are companies which are insurance companies that manage pension schemes. There are some trustees like NSSF which manage pension schemes. Then we are saying once the contributions are invested by the funding agent, it is that funding agent who normally pays the benefits at the time of retirement. Good. Now, as a company, how do you go into this kind of arrangement? We have said, how does a pension scheme operate? But as an employer, how do you go into a pension scheme? In what approaches? There are two approaches that you can use when you want to go into a pension scheme, or when you want to have a pension scheme on behalf of your employees. So what we want to talk about now is what we call types of pension schemes, types of pension schemes or pension plans. Let's call them pension plans. There are two types of pension plans or two approaches that you can use. One of them is what we call a defined contribution plan. Is what we call a defined contribution plan. So as an employer, you can go into a pension scheme using this approach, which we are calling a defined contribution plan. Number two, you can use what we call a defined benefit plan. You can go into a pension scheme using a defined benefit plan. Now, in your financial reporting, these are two terms you are reminded or you are required once in a while to define these terms and to distinguish between what's a defined contribution plan and what's a defined benefit plan. Even at the advanced level, there are questions. Sometimes you are given a theory question and you are told to distinguish between a defined contribution plan and a defined benefit plan. Now, going back, and I hope you can remember, the term already can tell you something. The term already can tell you something on what this kind of a plan is. When we say a defined contribution plan, and when we say a defined benefit plan, let me just remind you. I don't want to ask you, but of course you should know the difference. But for the sake of time, let me just remind you. Now, if your company decides to use as an approach we are calling a defined contribution plan, then in a defined contribution plan, the contributions that you as an employer, those contributions that you make into a pension scheme, the contributions normally they are defined. In a defined contribution plan, the contributions are defined in the sense that you as an employer, you know in advance how much you should be contributing to this fund. The contributions we are saying, they are defined. They are known in advance. Listen, but how much the employees will take home at the date of retirement 10 years from now, 20 years from now, the amount of the benefit in this approach, the amount is not defined. That means you don't know in advance how much the employees will take home at the date of retirement. We don't know in advance. So in a defined contribution plan, the contributions are defined. They are known in advance. But the benefits that the employees will take home at the date of retirement, those benefits are not defined. So the question is, before we go to that question or to that answer, now let us assume that you as an employer, you agreed with your funding agent that you are going to make a contribution of 2,000 for each of your employee every month or every year, whatever it is. So you as an employer, you know your contribution is known in advance. It will be 2,000 every month, 2,000 every month, whatever it is, for every employee, whatever it is. So your contribution is defined. But how much will the employee take home 10 years from now? That's the question. We are saying that amount is not defined. It's not known in advance. So the question is, what will influence the amount that the employees will take home at the date of retirement? Don't forget, I told you that these contributions are normally invested by the funding agent. These contributions are normally invested by the funding agent. Now, it is obvious, therefore, that if the investments perform well in that fund, if the investments perform well, then it means this funding agent will be able to afford to pay higher benefits to the employees when they retire. When the investments perform well, then the benefits will be more at the time of retirement. But if the investments perform poorly, then the benefits that the employees will take home at the date of retirement, those benefits will be low. So we normally say the amount of the benefits at the time of retirement will depend on the performance of the investments in the fund. And if the investments perform well, then the benefits will be more. If the investments perform poorly, then the benefits will be less. Good. So that's all we can say about the first approach. What is a defined contribution plan? Now listen. If you remember, Most students used to define this defined contribution as just saying, in a defined contribution plan, the contributions are defined, and you stop there. It's true, you have got one part of it, but you also need to talk about, in the same plan, how are the benefits affected. You don't just say the contributions are defined and you stop there. No, I'm saying you also need to say how the benefits are affected. So it means I'm talking from both ends, from the end of contribution to the end of benefits. How are they affected? Good. So that's all we can say as far as defined contribution plan is concerned. Good. Now let's go to the second type of plan. What's a defined benefit plan? Now, in a defined benefit, I hope you can see the term saying, in a defined benefit plan, the benefits that the employees will take home at the date of retirement, now those benefits are defined. Now those benefits are defined, meaning as an employee, you know how much you will take home 10 years from now, 20 years from now, and so on. You know in advance. Let's assume that you know at the date of retirement, you'll go home with 1 million as your retirement benefit, whatever it is. But then, in this second plan, how much are the contributions to the fund? Those contributions are not defined. The contributions are not defined. That means they are not known in advance. So the question again is this. How much then should the employer make as contribution? We are saying the amount of contribution is not known in advance. Listen, but that amount of contribution should be set at such an amount that is expected. The contribution should be set at such an amount that is expected to earn enough return to meet the obligation. Remember, the obligation is to pay 1 million shillings at the date of retirement. So you as a company make that contribution which is expected to earn enough return. Don't forget, the contributions are invested. So make that contribution which is expected to make enough return in order to meet this future obligation. So the question to you as a company is, how do I know how much to make as contribution? Because it's not known in advance. Listen, it is at this point in time, you as a company, you normally require the services of the actuaries. Some call them actuaries, whatever, okay? So it is at this point that you would require the services of the actuaries. These are people who value funds. You will call them and tell them, I want to make a contribution. No, I want to make or create a fund where the employees will take home 1 million 10 years from now. So you tell them to calculate for you how much you should be contributing to this fund. So you as an employer and the actuaries, you will sit down and come up with the assumptions of the scheme that you want to develop. For example, one of the assumptions of that scheme is how many employees do we have? What is their current salary? What are we expecting to be the market rate of return? That's one of the major assumptions you have to come up with. The expected market rate of return. Okay? Let us assume that you assumed that these investments will be earning a return of 10%. That is what we are projecting. So if the actuaries know that the expected rate of return is 10%, they will calculate backwards and see, for example, that if you make a contribution of 2,000 every month to this fund, if you make a contribution of 2,000 to this fund, earning a return of 10%, then we expect that after 10 years or 15 years, that will give you a fund of 1 million, whatever the case might be. Okay, so that's what we are saying, that these contributions will be set at such an amount that is expected to earn enough return to meet these future obligations. Now the question is, suppose after 1 or 2 years, your fund no longer is earning in the market 10%, or your contributions are not earning 10% in the market. When we started with the pension scheme, our return in the market was 10%. So we sat down and calculated that if we make a contribution of 2,000, earning a return of 10%, that will give me a fund of 1 million 10 years from now. But the question is, what if now our return is no longer 10%, but 8%? What happens? Remember, you will not change the amount of the benefit. But it is obvious. If as an employer, I continue contributing 2,000 now, earning a return of 8%, that will automatically not be able to meet this future obligation of paying 1 million. In other words, this fund will now develop what we call a deficit. So, we expected a return of 10%. We projected that if we make a contribution of 2,000, it will create a fund of 1 million. But now after 2 years into the scheme, now we realize the return is no longer 10%, but 8%. So that will create a deficit in the fund. So what do we do to correct for that scenario of a deficit? Listen, it is at this point now that the employer will be told to make additional contributions into the fund so as to make up for the expected shortfall. The employer will be told to make extra contributions to meet the expected shortfall, because we have said the contributions are not defined. They are set at such an amount that is expected to earn enough return. Good. So if the fund has a deficit, then the correction would be, let the employer make additional contributions into the fund so as to make up for the expected shortfall. But then the question now is, what if we projected 10%, fine, but now we are no longer earning 10% after 2 years? Maybe we are earning now 12%. What happens? We agreed with the actuaries and with the funding agent that we'll be making a contribution of 2,000. We were expecting it to earn a return of 10%, but now it's no longer earning 10%, but it's now earning 12%. So it is obvious, therefore, that if we continue contributing 2,000, earning a return of 12%, this fund of ours will be larger than expected. The fund will be larger than expected. In other words, this fund will now create what we call, or it will have what we call a surplus. So the question is this now. How do we correct for that scenario? Where you thought if you contribute 2,000, earning a return of 10%, that will give you a fund of 1 million. But now our fund is no longer earning 10%, it's now earning 12%, meaning our fund will have a surplus. How do you correct for that surplus? My question is to you. Now somebody help me there, because I told you we are reminding ourselves. You have done this before, but we still need to know it, because we shall use some of these terms later. How are you correcting that scenario? Somebody explain. How are you correcting that scenario? Chat. When the fund is larger than expected, what will happen to correct for that scenario? I told you, if the fund is less than expected, the employer will be told to make additional contributions. But now, what if your fund is larger than expected? What will happen? That's the question to you. Somebody correct, say something. Somebody to chat and say, good. The employer will be told to do what? Good. I think now somebody is picking the question now. Good. So it's correct. This is who? AW. You are right. Let me explain it. Good. You are right. Now, in other words, listen. When the fund has a surplus, the employer will be told to stop. The employer will be told to stop contributing for a short while. The employer will be told to stop contributing for a short while until we utilize the surplus, until we utilize whatever surplus is there. Listen, that process of stopping to contribute for a short while, that process is what we call, or what is termed as the employer being required to take what we call a contribution holiday. The employer will be told to take a contribution holiday. That means the process of stopping contribute for a short while is what we call, the employer will be told to take a contribution holiday. Good. So somebody by the name of EW, at least you have remembered. Good. So that's how a defined benefit scheme operates. It's a bit involving than the defined contribution. I have told you, in a defined benefit plan, the benefits are defined. You can't change the benefits. But the contributions are not defined. I have said the contributions are set at such an amount that is expected to earn enough return to meet the future obligations. Then I've told you, if the fund appears to have a deficit where you are now earning less than the projected return, the fund will have a deficit. To correct for that deficit, the employer will be told to make additional contributions. Then I've told you, if you expected to earn 10%, but now your fund is earning 12%, your fund will have a surplus. And to correct for that case, the employer will be told to take a contribution holiday. That means to stop contributing for a short while. Good. So before we proceed, let's put down something on what we have already said. Let's put down the summary note for all we have said up to there. So Andika, the topic is retirement benefits. Retirement benefits. We need to remind ourselves. I've said we need this information again in this topic of advance. Good. So the topic is retirement benefits. Then you say this. Then you say this. A pension scheme is an arrangement. A pension scheme is an arrangement. A pension scheme is an arrangement whereby the employer, a pension scheme is an arrangement whereby the employer promises to provide. A pension scheme is an arrangement whereby the employer promises to provide benefits, to employees, whereby the employer promises to provide benefits to the employees when they retire. Whereby the employer promises to provide benefits to the employees when they retire. So a pension scheme is an arrangement whereby the employer promises to provide benefits to the employees when they retire. I have another subheading, how a pension scheme operates. How a pension scheme operates. As a subheading, how a pension scheme operates. How a pension scheme operates. How a pension scheme operates. Then you say this. The employer and possibly the employee the employer and possibly the employee, make a regular contribution. The employer and possibly the employee make a regular contribution to a pension fund. Make a regular contribution to a pension fund. Full stop. These contributions are invested. These contributions are invested by the funding agent. These contributions are invested by the funding agent. These contributions are invested by the funding agent. These contributions are invested by the funding agent who later pays. These contributions are invested by the funding agent who later pays the benefits, to the employees when they retire. These contributions are invested by the funding agent who later pays the benefits to the employees when they retire. These contributions are invested by the funding agent who later pays the benefits to the employees when they retire. Another paragraph. The funding agent may be an insurance company or a trustee. The funding agent may be an insurance company or a trustee. The funding agent may be an insurance company or a trustee. Good. That's all about that. Another subheading, types of pension plans. 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 Number one, defined contribution plan. Number one, defined contribution plan. Number one, defined contribution plan. Then under that you say, number one is defined contribution plan. Then you say this. In this plan, the contributions to the fund, are defined. The contributions to the fund are defined, i.e., they are known in advance. They are known in advance. They are known in advance, but the benefits that the employees will take home, at the date of retirement, are not defined. They are not defined. Full stop. They are not defined. Full stop. Another paragraph. The amount of the benefits at the date of retirement, will depend. The amount of the benefits at the date of retirement will depend on the performance. Of the investments in the fund. The amount of the benefits at the date of retirement will depend on the performance of the investments in the fund. Will stop. If the investments perform well, if the investments perform well, if the investments perform well, then the fund will be able to afford to pay the fund will be able to afford to pay a higher benefits to the employees. If the investments perform well, then the fund will be able to pay a higher benefits to employees. A higher benefits to employees. And continue. And if the investments perform poorly, and if the investments perform poorly, and if the investments perform poorly, then the fund will pay less benefits. If the investments perform poorly, then the fund will pay less benefits to the employees. The fund will pay less benefits to the employees. Okay. Another paragraph. Number 2. That's number 1. Number 2, defined benefit plan. 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 That's number 2. Then you say this. In this plan, the benefits that an employee will receive, the benefit that the employees will receive at the date of retirement, in this plan, the benefits that an employee will receive at the date of retirement are defined. I.e. known in advance. They are defined, i.e. known in advance. They are known in advance. But the contributions to the fund, are not defined. But the contributions to the fund are not defined. Full stop. Another paragraph. The contributions are a set. The contributions are a set at such an amount. The contributions are a set at such an amount that is expected. The contributions are set at such an amount that is expected to earn. The contributions are set at such an amount that is expected to earn enough return, to meet the obligation. I've said the contributions are set at such an amount that is expected to earn enough return to meet the obligation of paying the benefits. 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 Another paragraph. Another paragraph. If it becomes, I've said, the contributions are set at such an amount that is expected to earn. I've said the contributions are set at such an amount that is expected to earn enough return to meet the obligation of paying the benefit. Don't forget, we were saying the obligation is 1 million. So you set the contributions at such an amount that is expected to earn enough return to meet the obligation of paying the benefits. Are we okay, Patrick? Frederick now? I continue. I've said I repeat. Frederick, are we together? Good. Another paragraph. Another paragraph. If it becomes apparent, that the investments in the fund, if it becomes apparent that the investments in the fund are insufficient to pay for the benefits, if it becomes apparent that the investments in the fund are insufficient to pay for the benefits, meaning there is a shortfall. If it becomes apparent that the investments, don't forget these contributions are invested. So we are gauging the investments with the obligation. So we are saying if the investments in the fund are insufficient to meet the obligation of paying the benefits, then the employer will be required. Then the employer will be required to make additional contribution. The employer will be required to make additional contributions to the fund. The employer will be required to make additional contributions to the fund so as to make up for the expected shortfall. The employer will be required to make up or to make additional contributions. I've said, if it becomes apparent that the investments in the fund are insufficient to meet the obligation of paying the benefits, the employer will be required to make additional contributions into the fund, so as to make up for the expected shortfall. If it becomes apparent that the investments in the fund are insufficient to make or to meet the obligation of paying the benefits, we have said, then the employer will be required to make additional contributions into the fund to make up for the expected shortfall. Another paragraph. If the funds with an apostrophe, if the funds assets, of course funds assets are investments. If the funds assets appear to be larger, than expected, if the funds assets appear to be larger than expected, then the employer may be allowed to take a contribution holiday. The employer may be allowed to take a contribution holiday. The employer may be allowed to take a contribution holiday, i.e., stop contributing for a short while. The employer may be allowed to take a contribution holiday, i.e., stop contributing for a short while. So we tell him to stop contributing. Let us first utilize the surplus that was created. Once we utilize the surplus, then he will continue. After we have already utilized the surplus. Good. That's all we have said so far. So let me progress. Let me proceed from there now. Let me proceed from there. That's what we have already said so far. Okay. So I'm developing the topic slightly now. As an employee, in the process of your employment, there are some benefits you may be entitled to. So what we want to talk about now are what are the various types of benefits that you as an employee, you are entitled to in the process of your employment. What are some of the benefits that you may be entitled to at the time, during the time of your employment? Number one is what we call short-term benefits. Don't write fast. Number two is what we call long-term benefits. Long-term benefits. Number three is what we call termination benefits. Number four is what we call retirement. We also call it post-employment benefits. Post-employment benefits. So these are the types of benefits that you as an employee, you may be entitled to in the process of your employment. We are not saying that you may be entitled to all of them. In some companies, yes. In some companies, maybe 2 or 3, whatever it is. So we want to define what are these types of benefits that you, as an employee, you are entitled to in the process of your employment. Now listen. Number one, short-term benefits. What type of benefits are these? These are benefits that accrue to you for a period of less than 12 months after providing a service to the employees. You as an employee, any benefits that accrue to you for services you have rendered, and that benefit accrue to you for service rendered within less than 12 months after providing a service, then that kind of a benefit is what we classify as a short-term benefit. So these are benefits that accrue for a period of less than 12 months. For a period of less than 12 months after providing a service. For example, you already know that as an employee, you are entitled to your salary at the end of every month. So that's a benefit that accrues to you for a period of less than 12 months after providing a service. So one of the examples is what we can say salaries and wages. That's one type of an example of a short-term benefit. Another one is there are some companies which tell their employees at the end of every year you are entitled to a bonus. Not all companies pay bonus, but there are some companies at the end of the year they give employees their bonus. So you as an employee, you know that at the end of every year I am entitled to a bonus, whatever it is. So bonus is another example of a benefit that you may be entitled to, and it accrues to you for a period of less than 12 months after providing a service. That's another example of a short-term benefit. Another one is the leave pay. Obviously, you know you are entitled to leave every year. And therefore, still when you are going on leave, you need to be paid. Leave pay is also another example of a short-term benefit. So short-term benefits by definition are those benefits that accrue to employees for a period of less than 12 months after providing a service. We are giving examples like wages and salaries, or salaries and wages, bonus, leave pay, and so on. There are many. Okay? Good. That's number one. Number two, long-term benefits. Long-term benefits. That again, you should be able to define it now. These are benefits that accrue to you as an employee for period exceeding 12 months. For period exceeding 12 months after providing a service to your employees. Any benefits that accrue to you for period exceeding 12 months after providing a service, then that kind of a benefit is classified as a long-term benefit. For example, there are some companies that could tell their employees, not all companies, but they tell their employees something like this: if you work with us for 10 years, 20 years, the moment you clock the 20th year or the 50th year or whatever of service, you will be entitled to this much. So you as an employee, you know that we have a policy that if I clock a service of 20 years or 10 years, whatever it is, then I'll be entitled to this amount. That kind of a benefit only accrues to you for period exceeding 12 months after providing a service. For example, you can have what we can call Jubilee benefits. Jubilee benefits. That's one example of a long-term benefit. Another one could be sabbatical leave. There are some companies whereby you are allowed to go for sabbatical leave. That means a leave of more than a year, and you are still being paid. When you go for a leave of more than a year and your company still pays you, then that benefit is still classified as a long-term benefit. So we are giving two examples of long-term benefit, that is Jubilee benefit and sabbatical leave, where you go for leave of more than a year and you are still being paid by your company, whatever it is. Good. That is another type of benefit. It's a long-term benefit, that benefit that accrues to you as an employee for period exceeding more than 12 months after providing a service. We go to number three, and that is a retirement benefit. Retirement benefit. No, let's first discuss termination. Termination benefit. Now, the term itself already, even when you are told to define, at least you should get something. Because some questions tell you to define it. When you are told to define what's a termination benefit, it is obvious one should be able to say something. Now, termination benefit is normally two-sided. Let me explain it. It's normally two-sided. One side of it, it is that benefit that you as an employee, you are entitled to because of your employer's decision. Because of the employer's decision to terminate your services before the normal retirement date. That benefit you are entitled to because of the employer's decision to terminate your services before the normal retirement date. That's one side of it. The other part of it is there are some companies that tell their employees something like this: we are restructuring this company and we want to provide a package. You as employees, look at this amount we are going to give you. If you accept it, then you can take it and retire early. Okay? We are giving you an option. Look at this package. See whether it's okay with you. If you accept it, take it and leave. You voluntarily retire early because you are receiving a package. So the other side of termination benefit is where it is the employee's decision, now not the employer. It is the employee's decision accepting an early voluntary retirement in exchange of a benefit. You're told, this is our package. You want to take it and go. Some of the employees will take it and leave. Some will say it's too low. They continue working. But it is that kind of a benefit that you as an employee you are entitled to because of your own decision, you as an employee, to accept an early retirement in exchange of a benefit. Of course, you have had things like golden handshake. This is an example of what we are calling it, a golden handshake, where you are told, take this package, leave. So in other words, we are saying now, termination benefit, we are saying it's two-sided. It is one side, that benefit that an employee is entitled to because of the employer's decision, to terminate the employee's contract before the normal retirement date. Or it is that benefit an employee is entitled to because of accepting an early voluntary retirement in exchange of a benefit. Good. That's what we can say about termination benefit. We now go to the last one. That is retirement benefit. We also call it post-employment benefit. Now, by the term itself again, retirement benefit, these are benefits that an employee is entitled to at the date of retirement or near the date of retirement. Any benefit that you are entitled to at the date of retirement or near the date of retirement, then that benefit is what we call retirement or post-employment benefit. It is obvious. The most common one is pension, as an example of a retirement benefit. You are entitled to your pension at the date of retirement or even after the date of retirement. Good. There are some companies also whereby they tell their employees something like this, that even after you have retired, we are still going to provide you with medical care. So if your company has such an arrangement where they provide you medical care even after retirement, then that kind of a benefit is classified as a post-employment benefit. So we are giving an example of a post-employment medical care, as another example of a retirement or what we are calling post-employment benefit. So these are benefits that an employee is entitled to at the date of retirement or after the date of retirement. We are giving an example like pension or post-employment medical care. Good. I think we can now put down the summary notes on those 4 types of benefits before we proceed. There are some questions that I've asked you to distinguish. Maybe one, they tell you write short notes on the following types of benefits, whatever. So these are terms you should be able to define whenever you are told to define. So let's define them. So andika subheading, types of benefits. Types of benefits. Types of benefits. Number 1, short-term benefits. Short-term benefits. Short-term benefits. Then you say this. These are benefits that accrue, or put it this way, these are benefits falling due. Maybe we can put it that way. These are benefits falling due. These are benefits falling due within 12 months. These are benefits falling due within 12 months after providing a service. after providing a service. These are benefits falling due within 12 months after providing a service, e.g., salaries and wages, e.g., salaries and wages, bonus, leave pay, etc. Bonus, leave pay, etc. Number 2, termination benefits. Termination benefits. Long-term benefits. Let's put down the long-term one first. Long-term benefits. Long-term benefits. Then you say this. These are benefits accruing. These are benefits accruing for periods exceeding. These are benefits accruing for periods exceeding 12 months. These are benefits accruing for periods exceeding 12 months after providing a service. After providing a service. After providing a service. e.g., Jubilee benefits, e.g., Jubilee benefits, and sabbatical leave. And sabbatical leave. E.g., Jubilee benefits and sabbatical leave. That's number 2. We have said e.g., Jubilee benefits and sabbatical leave. Number 3, termination benefits. Termination benefits. Termination benefits. Number 3, termination benefits. Then you say this. These are benefits payable. These are benefits payable either. These are benefits payable either as a result of. Either as a result of. Either as a result of the employers with an apostrophe. Either as a result of the employer's decision. Either as a result of the employer's decision to terminate. To terminate the employees, again with an apostrophe, to terminate the employee's contract. To terminate the employee's contract before the normal retirement date. 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 Comma, or before the normal retirement date, comma, or on the employees, again with an apostrophe, or on the employee's decision, or on the employees with an apostrophe, or on the employee's decision to accept, or on the employee's decision to accept an early voluntary retirement, an early voluntary retirement in exchange of the benefits. 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 That's number 3. Number 4. Number 4, a retirement. Number 4, retirement stroke post-employment benefits. Retirement stroke post-employment benefits. Retirement stroke post-employment benefits. Retirement stroke post-employment benefits. Can you say this? These are benefits that accrue to employees. These are benefits that accrue to employees after the normal retirement date. These are benefits that accrue to employees after the normal retirement date. After the normal retirement date, e.g., pension, and post-employment benefits. Age pension and post-employment benefits. Age pension and post-employment benefits. Age pension and post-employment benefits. Good. Now, before we start some few calculations, because we are almost now approaching the topic in terms of computation. I'm not saying the theory parts are wrong. They are still tested. But before we do some few computations now, I want to talk about other terms used in pension. These are terms we shall use in our computations, so we need to understand them first before we do a few calculations, because we shall be mentioning again and again. Not only that, even some theory asks you to define them. Okay, so let me go through them first. What are these other terms that we need to know when it comes to this topic, and also for the purpose of doing calculations later? Good. Number 1 is what we call current, or we also call it present, service cost. That's one of the terms you may be told to define, and we shall also be using it in the topic or in our calculations. You will be hearing me saying current service cost, or what we call present service cost. Good. Number 2 is what we call past. We also call it prior service cost. That's another term you may be told to define, or you need to know it, what it is, so that when you are talking about computations, you know what it is. The other term you need to know is what we call actuarial gains or losses. This is a term we shall be using again and again when we are doing computations. You will be required to compute what we call actuarial gains and actuarial loss in the fund. Okay. Number 4, another term you need to know is what we call experience surplus stroke deficit. What are these terms? Experience surplus stroke deficit. Finally, number 5, you also need to know what's an experience adjustments. What are experience adjustments? Good. Let me go through each of the terms. Then from there we shall use them in our calculations. Number 1 is what we are calling current service cost. Now, let me explain it. You as a company You started operating many years ago. But from those many years ago, you did not have a pension scheme for your employees. This year, you decided you want to start having a pension scheme on behalf of your employees. You want to operate a pension scheme on behalf of your employees. So you decide every month the employees will give you a service. You will be sending some contributions. Every month the employees will give you a service. You send contributions to the scheme. Every month they send you, or they make a contribution, they give you a service, you send contributions to the scheme. Now listen, those contributions made for services rendered after the scheme has been initiated. Let me assume our initiation was done from 2025 this year. So every time the employees give you a service, you send contributions, maybe on a monthly basis, to the pension scheme or to the pension fund. That kind of a contribution is what you as an employer, you will account for it in your books as a current service cost. You will account for it as a current service cost. We also call it present service cost. So these are contributions made for services rendered after the scheme has been initiated. Those contributions made to the fund after the scheme has been initiated, then that kind of a contribution is what we call a current service cost. That's all we can say about current service cost. The contributions made to a pension fund for services rendered after the scheme has been initiated. Good. Now listen. You as a company, we have said you have operated for many years, but you didn't have a pension scheme. So you could also have decided this year 2025, you also want to make contributions, listen, for services the employees gave you in the year 2024 or maybe in the year 2023. You are in the year 2025. 2023 you did not have a pension scheme. 2024 you did not have a pension scheme, and the other years. But you decide this year 2025 that as an employer, I also want to make contributions for services rendered to me before the scheme was initiated. So how will you account for those kind of contributions in the books of 2025? You will account for them as a past, for what we are calling prior service cost. So these are contributions made for services rendered before the scheme was initiated. Okay, so we are saying you want to make contributions for services that were rendered last year, or still you are making a contribution of in February, but you realize for January you did not make the right one, so you want to add something for January, but you are making it in February. So you still call it a past service cost. You are correcting for some service of the past. So it could be for a year before the scheme was initiated, or it could be still within the same year when the scheme was initiated, but you are correcting something in the past. Either you wanted to make more contribution in February for services that were given to you in January, you feel you did not send enough, or you felt you want to increase the contributions for February, for January, whatever it is, but it's affecting a service that has already been rendered in the past. So we call it a past service cost. So in essence, we can just say this: it's a contributions made for services rendered before the scheme was initiated. In most cases, that is the case. So I'm through with number 2. Contributions made, services rendered before the scheme was initiated. You will account for them in the books of 2025 as a past service cost. Good. We move on. Number 3, actual gain and losses. That's important. Before I explain what's an actual gain or loss, I want to take you back to the different types of a pension plan. Different types of a pension plan. I told you there are two. One of them is what we were calling a defined benefit plan. A defined benefit plan. In this plan, I told you that contributions are made to a fund. Of course, in both cases, benefits are paid. These are contributions and benefits are paid out of the contributions. Then I told you, in a defined benefit plan, the benefits are defined. And we were assuming 1 million. But then I told you the contributions to the fund, they are not defined. They are not known in advance. Then I told you the contributions are set at such an amount that is expected to earn enough return. I told you, you sat down, came up with the assumptions. One of the assumptions that you came up was, what is the rate of return in the market? We projected the rate of return will be 10%. Then we said, how much therefore should be the contribution I make for me to create a fund of 1 million 10 years from now? You agreed with the actuary that let me contribute 2,000. Then I have told you, what if after 2 years, your fund is no longer earning 10%, but it's earning 8%? And I told you, your fund will have what? A deficit. How do you correct for that deficit? You tell your employer to make additional contribution. Are we there? Good. Then I've just told you, what if your fund is no longer earning 10%, but earning 12%? Then I told you, your fund will have a surplus. What do? When your fund has a surplus, I said the employer will be required to take a contribution holiday until we utilize the surplus. Good. Now listen. We expected a return of 10%. But listen, if the actual earnings in the fund exceed the projected earnings, the actual earnings in the fund, if they exceed the projected earnings, then we say this fund has an actuarial gain. This fund has an actuarial gain. So an actuarial gain occurs where the actual earnings exceed the projected earnings. We projected an earning of 10%, but our fund is now earning 12%. So our fund will have what we call an actuarial gain. But if your fund is earning 8%, while we projected 8%, therefore we are saying if the actual earnings in the fund are less than the projected earnings, if the actual earnings in the fund are less than the projected earnings, then the fund is said to have what we are calling an actuarial loss. To have what we call an actuarial loss. So an actuarial loss occurs when the actual earnings in the fund are less than the projected earnings. When the actual earnings in the fund are less than the projected earnings, then we say your fund has an actuarial loss. But when your actual earnings in the fund exceed the projected earnings, then the fund is said to have an actuarial gain. Good. That's all I can say. What's an actuarial gain? I've said an actuarial gain occurs when the actual earnings in the fund exceed the projected earnings. Actuarial loss occurs when the actual earnings in the fund are less than the projected earnings. Good. That's all I can say that. Next term is what I called experience surplus and deficit. Listen, It's still very much related to what we have said. Don't forget, I've just mentioned deficit when I was explaining this defined benefit plan. I also mentioned surplus when I was explaining. Now, listen. So when you're taught to define what's an experience surplus, what is an experience deficit? Now listen. I told you, in a defined benefit plan, the benefits are defined. How much the employee will take home at the date of retirement is known. That means our obligation as a company, our liability as a company is 1 million 10 years from now. So you as a company, you may want to know, as a company, are we able to meet that obligation? Or in other words, as a fund, are we able to meet that obligation of paying 1 million? For you to know whether your fund is able to meet that obligation, listen to this now. Now you can compare the assets of this fund with the liabilities of the fund. Of course, the liability is 1 million. That does not change. That's the obligation. But is our fund able to meet that obligation? For us to know whether the fund is able to meet that obligation or not, we compare the assets of the fund. Don't forget, the assets of this fund are in form of investments. Every time we send contributions, the fund agent is investing. Either is buying shares or they are buying property, whatever it is. They are buying building, whatever it is. Those are still investments. So if you want to know whether your fund is able to meet the obligation, you can compare the assets of the fund with the liabilities of the fund. Listen, if the assets of the fund exceed the fund's liabilities, if the fund assets exceed, just a minute, if the fund assets exceed the fund's liabilities, then we say your fund has an experience surplus. If your fund assets exceed the fund's liabilities, then the fund is said to have an experience surplus. But if the assets of the fund are less than the fund's liabilities, then the fund is said to have what we are calling an experience deficit. So in other words, we are saying an experience surplus occurs where the fund assets exceed the fund's liabilities, and an experience deficit occurs where the fund's assets are less than the fund's liabilities. Now listen, I've defined what's an actual gain, actual loss. I've defined what's an experience surplus, experience deficit. Listen, but these are still terms which are related. Listen to this. I told you we projected to earn 10%. Now we are earning 12%. What will happen to the fund if we continue contributing 2,000, earning 12%? The fund will have a surplus. I told you that. And I've also said, if you're earning 12% than over 10% projection, your fund is said to have an actual gain. So an actual gain, in other words, will automatically lead to your fund having a surplus. I also told you, you projected a return of 10%, but now you're earning 8%. Your fund has an actual loss, where the actual earnings are less than the projected earnings. Then I also told you, if we continue contributing 2,000, earning 8%, what will happen to the fund? The fund will obviously have a deficit. So the actual gain and actual losses, experience surplus and experience deficit, all of them come up because of the same scenario. But it's the definition that is separating them. But the effect in the fund is the same. Listen, When you are told to explain what's an actual gain, I said you compare the earnings in the fund, not assets, the earnings in the fund with the projected earnings. Actual earnings being more than the projected earnings, that gives rise to an actual gain. Then I say what's an experience surplus, where assets of the fund are more than the liabilities of the fund. That gives up an experience surplus. But the effect is the same. What brought a surplus is because we were earning at a higher rate than we had projected. That made our fund to have a surplus. Okay? So actual gain, actual surplus as experience surplus, the same. But the definition is what is separating them. That actual gain or losses, I hope you're following, actual gain or losses, we are looking at them from the point of view of the earnings. Earnings. If the earnings in the fund are more than the projected earnings, actual gain. If the actual earnings are less than the projected earnings, actual loss. What's an experience surplus and experience deficit? It is if the assets in the fund are more than the liabilities in the fund, that automatically gives rise to an experience surplus. If the fund assets are more than the fund's liability, then you have a surplus. If the fund assets are less than the fund's liability, then you have an experience deficit, which is of course the same, which gave rise to that is the actual loss that gave rise to experience deficit. Good. So now you know. I've said the definition is what matters, but the effect in the fund is the same. Whether you are discussing experience surplus, it's when the assets are more than the liabilities. And how did that come about? It's because you earned more in the fund than you projected to earn. That's what we call the actual gain. What's an experience deficit? It's when the assets in the fund are less than the liabilities of the fund. What made that to happen is because we earned less, the earnings were less than the projected ones. That's what made to have a deficit. Okay, good. Finally, the last term is what we were calling experience adjustments. Number 5. Now listen. Experience adjustments go with the experience surplus and deficit. And I hope you can explain what are these adjustments. I still told you, when the fund assets are more than the liabilities, if it becomes apparent, you remember I was writing the notes that way, if it becomes apparent that the assets in the fund exceed the fund's liabilities, what do? I told you the employer will be told to take a contribution holiday. When your fund has a surplus, the employer will be told to take a contribution holiday. So that's the adjustment that should be done in a fund which has a surplus. It is called an experience adjustment. It is to correct. Those are adjustments that are there to correct either an experience surplus or to correct an experience deficit. To correct an experience surplus, we have said, let the employer take a contribution holiday. In other words, let him stop contributing for a short while. How do we correct for an experience deficit? You remember, we said the employer will be told to make additional contribution. We can't meet our obligation. What do you tell the employer? Please make additional contributions into the fund so as to make up for the expected shortfall. That is the adjustment to be done. So our experience adjustments are those adjustments that are there to correct either an experience surplus or an experience deficit. And I've already said to correct an experience deficit, the adjustment is let the employer make additional contribution. What's the adjustment to correct experience surplus? This is an adjustment that we have said, let the employer take a contribution holiday. Good. So I think I've defined those terms. So we need to put them down. Then we now can do a few calculations. So put down another subheading, put down another subheading, other terms used in pension. 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 Number one, current service cost. Current service cost. Current service cost. Current service cost. Or you could have said current stroke present service cost. Put it that way. Current stroke present service cost. Current stroke present service cost. Then you say this. These are contributions made to the fund. These are contributions made to the fund for services rendered after. These are contributions made to a fund for services rendered after the scheme, after a pension scheme. Put it that way. These are contributions made to a fund after a pension scheme has been initiated. These are contributions made to a pension fund after the scheme has been initiated. After the scheme has been initiated. Number two, past stroke prior service cost. 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 These are contributions made. These are contributions made to the fund. These are contributions made to the fund for services rendered before the scheme was initiated. These are contributions made to the fund for services rendered before the scheme was initiated. These are contributions made to a pension fund for services rendered before the scheme was initiated. Number three, actuarial gain stroke losses. Actuarial gains stroke losses. Actuarial gains stroke losses. Then you say this. Actuaries, you can call them actuaries, whatever you want to call them. Actuaries deal with several uncertainties. Actuaries deal with several uncertainties when estimating. Actuaries deal with several uncertainties when estimating the cost of a pension scheme. Actuaries deal with several uncertainties when estimating the cost of a pension scheme. Full stop. So we have said actuaries deal with several uncertainties when estimating the cost of a pension scheme. Full stop. In resolving these uncertainties, they usually make assumptions. In resolving these uncertainties, they usually make assumptions. They usually make assumptions. They usually make assumptions. We'll stop. Continue. Assumptions are made on areas such as. Assumptions are made on areas such as. Assumptions are made on areas such as market interest rate. Assumptions are made on areas such as market interest rate, retirement date, salary increments in the future, workers' turnover rate, etc. Another paragraph. Rarely do the projected results coincide with the actual results. Rarely do the projected results coincide with the actual results. Rarely do the projected results coincide with the actual results, thereby giving rise to actual gains stroke losses. Thereby giving rise to actual gains stroke losses. Another paragraph. Actual gains occur where the actual earnings in the fund exceed the projected earnings. Actual gains occur where the actual earnings in the fund exceed the projected earnings. Actual gains occur where the actual earnings in the fund exceed the projected earnings. Another paragraph. Actual losses occur where the actual earnings in the fund are less than the projected earnings. Where the actual earnings in the fund are less than the projected earnings. Actual losses occur where the actual earnings in the fund are less than the projected earnings. Good. That's all for that. Next. I think that's number 4 now. Number 4. Experience surplus stroke deficit. The next term is experience surplus stroke deficit. Experience surplus stroke deficit. Experience surplus stroke deficit. Then you say this. In determining whether a fund is able to meet its obligation. In determining whether a fund is able to meet its obligation. of paying the benefits in determining whether a fund is able to meet its obligation of paying the benefits at the date of retirement, to determine whether a fund is able to meet its obligation of paying the benefits at the date of retirement, the funds with an apostrophe, the fund's assets are compared. The fund's assets are compared with the funds, again with an apostrophe, the fund's assets are compared with the fund's liabilities. The funds with an apostrophe, the fund's assets are compared with the fund's, again with an apostrophe, liabilities. The fund's assets are compared with the fund's liabilities. Another paragraph. Where the fund's assets, put it this way. Let me reframe that statement. That next paragraph, let me reframe it. An experience surplus, put it that way. An experience surplus occurs. An experience surplus occurs where an experience surplus occurs where the funds, again with an apostrophe, where the fund's assets exceed the fund's liabilities. Where the fund's assets exceed the fund's liabilities. Where the fund's assets exceed the fund's liabilities. Okay, we have said an experience surplus occurs where the fund's assets exceed the fund's liabilities. Another paragraph. An experience deficit. An experience deficit occurs. An experience deficit occurs. An experience deficit occurs where the fund's assets are funds with an apostrophe, where the fund's assets are less than, the funds, again with an apostrophe, are less than the fund's liabilities. Experience deficit occurs where the fund's assets are less than the fund's liabilities. Good. That's all for number 4. Let's go to the last one. Experience adjustments. That was the next term. Experience adjustments. Experience adjustments. Experience adjustments. Then you say this. These are adjustments that are made. These are adjustments that are made to a fund. These are adjustments that are made to a fund to correct. These are adjustments that are made to a fund to correct either an experience surplus or an experience deficit. These are adjustments that are made in a fund to correct either an experience surplus or experience deficit. Another paragraph. To correct an experience surplus. to correct an experience surplus, the employer to correct an experience surplus, the employer may be allowed. The employer may be allowed to take a contribution holiday. The employer may be allowed to take a contribution holiday. To correct an experience surplus, the employer may be allowed to take a contribution holiday, i.e., stop contributing for a short while. I.e., stop contributing for a short while. Stop contributing for a short while. Next, another paragraph. To correct an experience deficit. To correct an experience deficit. To correct an experience deficit, comma, the employer may be required. The employer may be required. The employer may be required to make additional contributions. The employer may be required to make additional contributions into the fund. The employer may be required to make additional contributions into the fund so as to make up. The employer may be required to make additional contributions into the fund so as to make up for the expected shortfall. So as to make up for the expected shortfall. So as to make up for the expected shortfall. Good. So we are through with those terms. So we want to start now doing some few computations. Now we are ready to introduce the computations. And now we start doing those calculations from your past papers. Now, the only thing is we don't have enough time to start and complete any computations. So you will allow me to stop there for today. And I will introduce that in the next lesson. I will introduce that in the next lesson. Now listen. Some of you are here, or you have friends who have not joined our online classes. Okay? So if you are here and you have friends who have not joined our online classes, tell your friends that we have online classes for the following subjects. 1, we have online classes for advanced financial reporting of the advanced level, like the one we are doing today. We also have online classes for financial reporting of the intermediate level. Tell your friends that we also have online classes for financial management of the intermediate level. We also have online classes for financial accounting of the foundation level, and the one of ATD1 and ATD2, because they also have financial accounting. Those are the 4 subjects we are offering online classes for. Now, if you are not able to join the live classes for whatever reason, then you can still buy what we call the pre-recorded videos. You can still buy what we call the pre-recorded videos, where you watch them at your own free time, at your own pace, because the content of the live class and the content of the pre-recorded is the same. So if they are not able to join the live class, tell them that they can buy the pre-recorded videos, watch them at their own free time. Whenever they have a question, they can call me anytime. Okay? To reach me, they can call me on this number, 0722 658875. Tell them that that's my contact, or if you are here and you still want to join, you can join. Okay? If you want the country code, that is 254-722-658875. Good. That's how you can reach me for cost, and how we accept payments on installments also. With that one we accept. Good. Now, another point. Some of you are watching me through YouTube, and maybe you have not subscribed to my YouTube channel. Please click that subscription button down there. If you have not subscribed, click that subscription button. If you are watching me through YouTube, click that subscription button to subscribe, so that you may be notified whenever we post new videos into the YouTube. Okay? Now, of course, even in the same YouTube, we have some few videos that are there for promotion. You can still go back and watch some of those videos. They are there for promotion. The name of the YouTube channel is called CPA Joseph Njuguna. That's the name of the YouTube channel. So if you go to the YouTube and you click that name, or you search that name, that will give you my YouTube channel, CPA Joseph Njuguna. So click that subscription button so that you may be notified whenever we post new videos into the YouTube. Okay? Finally, you're watching me through YouTube and at least you have liked the class. I would also ask you to click that like button. Click that like button to like the video. I want to believe that today you have understood something. You have gone home with something through this online class. That you like, at least you have understood something. So click that like button. You can even give a comment. You can give a comment in that class or that section of the comment. Let me stop there for now. I continue from there next time. But please tell your friends we have those 4 subjects as at now for online classes. That is for advanced financial reporting, financial management, and financial accounting. Then if they want to reach me, they can call me through that number 0722 658875. You could also be here. If you have not joined our classes, please join. Otherwise, bye for now. See you next time. Unless there's a comment. I hope you have understood for today again. Unless somebody has a comment you want to put down. So next time we now go into the pure calculations for the topic now. We go and do past paper questions for that class or for this subject now, this topic now. So unless there's a comment, maybe we can stop there. We pick it up from there. I also do hope that you have also understood something today. For those who are watching me through Zoom, I want to believe you can say something in the comment section or in the chat. Unless there's something. Yes. Thank you. So maybe we can see you next time. Well understood. Somebody saying well understood. Thank you. We have great explanation. Thank you. If you have not joined, please join. Fine. See you next time. Call me on that number if you need my videos. We shall talk about the cost and how to pay. Bye.